Fed will pivot when the market makes them, and the number one thing to make them pivot is probably the stock market going down, the S&P 500 dropping at a higher velocity. It's been hovering around this 4,000 level, up or down 200 points from that. And I think it's just inevitable at some point it tilts back down because the Fed's not going to ease, it looks like, until it doesn't. I mean, the jaw opening from the Fed governors is quite serious. They keep talking about higher rates, despite the data we've seen all this week. They're starting to get that trend of misses, misses on PPI, misses on retail sales. It's just, to me, part of what happens in a recession. I think that's the stage we're at right now.
Despite a minor decline in gold prices following its second highest settlement level ever, Bloomberg Intelligence senior macro strategist Mike McGloan is optimistic about the market. McGloan noted on Thursday that the price of gold is still expected to rise for a seventh straight week. Gold, in his professional opinion, will break through the $2,000 per ounce mark and rise in tandem with the stock market, where it may play a significant role in its overall performance. McGloan elaborated on his optimistic view of gold by saying it is one of the few commodities he expects to do well in the current economic climate. He explained it by the widespread adoption of deflationary trends. He added that the market would force a change in direction for the Federal Reserve this year if the central bank did not do so first. McGloan also pointed out how the deflation of fossil fuels is leading to inflation in gold by discussing the correlation between crude oil and the precious metal. The relationship between the two commodities is seen as a potential plus for gold investors. McGloan advised investors to buy gold to take advantage of this situation, noting that doing so is now simpler than ever thanks to exchange-traded funds, ETFs.
But I think it's inevitable that gold gets above this $2,000 an ounce level and never looks back. And the key catalyst is the stock market potentially rolling over. And here's a big difference with gold compared to the stock market. I look at gold versus the S&P 500. It's very low on a 120-month basis. A 10-year basis is basically unchanged. The stock market total returns around 300% or so. Those are starting to reverse. And the big difference, the last time we did this was really around the start of the new millennium, was the Federal Reserve was well into an easing cycle. So I see this as just the catalyst for gold to take off. It's one of the few commodities I'm really bullish on because everything's starting to tilt downward towards deflationary trends.
Yeah, and we definitely have seen investors pouring into gold. Talk to us about what happens if the Fed doesn't pivot this year. I mean, what will happen to gold in that scenario?
Markets will make them. I think that's the stage we are right now. The Fed will pivot when the market makes them, and the number one thing to make them pivot is probably the stock market going down, the S&P 500 dropping at a higher velocity. It's been hovering around this 4,000 level, up or down 200 points from that. And I think it's just inevitable at some point it tilts back down because the Fed's not going to ease, it looks like, until it doesn't. I mean, the jaw opening from the Fed governors is quite serious. They keep talking about higher rates, despite the data we've seen all this week. They're starting to get that trend of misses, misses on PPI, misses on retail sales. It's just, to me, part of what happens in a recession. I think that's the stage we're at right now. The markets are getting it. 2-year-note yields, 10-year notes are getting it, but the Fed is still being vigilant against inflation, which is collapsing. You look at PPI, I see PPI in a year-over-year basis heading towards negative by the time we get to July. And that's just what happens normally when commodities collapse.
And you have an interesting note about the relationship between crude oil and gold. So what do you see, because most investors maybe aren't thinking that way, what do you see between that relationship and where gold can go?
The crude oil is an enduring bear market that had a bounce last year and tilting back towards that bear market aggressively. On a 12-month basis, it's down about 20%. $80 a barrel in this year's range has been between 65 and 85. It's still the upper end of range. I think it's going to go lower. And follow natural gas. Natural gas has dropped 80% from last year's peak. It's the number one measure of heat, electricity, and fertilizer this country, and it's at this cost of production, a price it first started trading in 1990. I think crude oil is going to do that and go towards 40. So basically, deflation in fossil fuels is encouraging inflation in gold. And I think that's just starting to kick in and accelerate. You see the end of the quarter, end of 1Q close in gold was the highest ever. It's just hovering around that $2,000 level. And the key question I ask is what stops this? The Fed is still tightening. Typically, when you have commodities collapsing at this velocity in the past, the Fed has already been easing, and they're still vigilant against that. So I see what we're doing is heading towards
the markets
a severe
appear to be ignoring the U.S.
recession,
recession
as indicated
for the
by
time
commodities,
being.
by the Fed still tightening, the curve's significantly inverted, and now we have a pretty pretty serious credit crisis going on with just pulling back of deposits from the major banks. That means it's just starting to get started. And the key thing I'll end with is that we were just looking at annualized industrial demand for natural gas in this country. It's the lowest in 6 years now, and that's an annualized basis, so it's not seasonal.
How do you think investors should buy gold? I mean, for people that are just looking at this gold rally, this recent gold rally, and thinking, man, I want to get in on this. I mean, what is the best way? Is it through ETFs? Should they be buying physical gold? What do you say?
Well, that's the thing that ETFs made so much easier for people like me who used to, I was kind of afraid to buy physical gold before ETFs, so you buy equities. ETFs are such an easy way to do it. It's quite clear, but I think one thing that's going to be coincident with this gold rally is the rally we're having in U.S. long bonds and declining yields. So ETFs are just an easy way to express those views and investments.
And the miners?
Well, it's the history of miners. Miners, you have to be more selective. You can get those many X's of returns, but you have to be selective. The overall miners, like the GDX index, has a history of underperforming gold over time. The key reason for that is you just can't create more gold cost effectively like you can crude oil and a lot of other commodities. So overall, that physical ETFs that track gold have a history of outperforming indices like the GDX index, which is just an index of miners.
Instead, they are putting a premium on predicting when the Federal Reserve will make a policy U-turn by year's end. Consider the ramifications of that, though. There has been little talk from policymakers about lowering interest rates this year, and inflation remains high. Therefore, volatility may return in Q2 if there is a realignment. U.S. retail sales dropped 1% in March, following a revised 0.2% decline in February, fueling concerns that the country may be re-entering a recession as consumers cut back on spending. In light of recent statistics released by the United States Department of Commerce, core sales, which exclude vehicle sales, also fall short of expectations, dropping 0.8% last month rather than the 0.1% drop that was expected by economists. Drought, 0.3% according to the report's control group, which excludes automobiles, gasoline, construction supplies, and the food service industry, conforming to the expectations of the majority. Gold is seeing some technical selling pressure, but this is not being driven by the dismal economic data. There are early signs of cracks beginning to form in the U.S. economy after Thursday's rally to a fresh 13-month high as momentum fades. Most of this is due to disappointing economic data that has been weakening from previous prints. What ramifications does this have for the 2Q financial markets? Leave a comment and tell us what you think. Thank you for watching Market Empire. We hope you found this video informative and helpful in understanding how to prepare your family for the future. If you have any questions or would like to learn more about finance and investing, be sure to subscribe to our channel and hit the notification bell to stay up to date on our latest content. And as always, stay smart and stay ahead of the game.